or wherever you are, and whatever time you're listening to this. Good morning, good afternoon, and good evening. This is the Market Color Podcast, where we keep you posted on the latest developments in the financial markets, and we do that by first giving you a broad overview of the global markets, so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week, so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 206, and in this episode we're reviewing the performance of the financial markets during the 13th week of 2026, and that is from Monday the 30th of March to Friday the 3rd of April. And without further ado, this is your host, Jamuhuri, and together, let's dive right in. We kick it off in the United States, where the U.S. labor market bounced back in the month of March with job creation much stronger than expected, though the broader picture of slow growth in the labor market held intact. According to the Bureau of Labor Statistics, Nonfarm payrolls rose by a seasonally adjusted 178,000 jobs in March, which was a reversal from the decline of 133,000 jobs in the month of February, and much better than the Dow Jones consensus estimate for 59,000 new jobs. The jobs number for February was revised down by 41,000 jobs, whilst the January data was revised up by 34,000 to 160,000 new jobs, putting the 3-month average at around 68,000 jobs per month. Meanwhile, the unemployment rate edged lower to 4.3%, but this was largely due to the sharp reduction in the labor force, as the share of working-age Americans in the labor market fell to 61.9%, which is the lowest level since November 2021. Staying in the United States, earlier in the week on Wednesday, ADP, the payrolls processing company, reported that private sector employment growth was much better than expected in the month of March, as the healthcare sector and continued to provide momentum to the labor market. The ADP report, which does not include government employees, showed that the private sector created a total of 62,000 new jobs in the month of March, compared to February's upwardly revised number of 66,000 new jobs, and was much better than the Dow Jones consensus estimate for 39,000 new jobs. Moving over to the Eurozone, according to the latest preliminary figures released by Eurostat on Tuesday, inflation in the Eurozone jumped from 1.9% in February to 2.5% in March, which is well above the European Central Bank's target rate of 2%. The pickup in inflation was largely attributed to the sharp increase in energy prices following the launch of military operations by the US and Israel against Iran at the end of February. European Central Bank President Christine Lagarde said last week that the central bank was watching regional data closely and would respond with interest rate hikes if necessary, even if a surge in inflation proved to be short-lived. The central bank has already revised its growth and inflation forecast for the medium term and now expects economic growth of 0.9% in 2026, with headline inflation averaging at 2.6% for the year. On Wall Street this past week, the Dow Jones Industrial Average slipped on Thursday in volatile trading as oil prices surged following President Trump's remarks that the Iran war would continue for another 2 to 3 weeks. The three major indices shot up higher from their steep losses earlier in the day to briefly turn positive after Iranian state media said that the country was working with Oman on a protocol to monitor ships passing through the Strait of Hormuz. The indices oscillated between gains and losses throughout the session following these developments. Meanwhile, the volatility index, otherwise known as Wall Street's fear gauge, touched a session high of more than 27. And by the close of trading on Thursday, ahead of the long Easter weekend, the blue chip Dow Jones Industrial Average was down marginally by about 61 points before closing at 46,504, as the broad market index, that is the S&P 500, ticked up by 0.11% to end the session at 6,582, and the tech-heavy Nasdaq Composite was a shade higher as it gained by 0.18% before settling at 21,879. In the U.S. bond market, Treasury yields ticked lower on Thursday as traders assessed the latest developments in the ongoing war in the Middle East to close out a volatile and holiday-shortened week. Treasury yields moved lower on the back of an announcement that Iran and Oman were reportedly drafting a protocol to monitor traffic through the Strait of Hormuz. And in an address to the American people on Wednesday evening, President Trump said that he expected the war in Iran to last another 2 to 3 weeks. In response, the yield on the short-dated 2-year Treasury note was down by less than 1 basis point at 3.80%, whilst the yield on the benchmark 10-year Treasury bond fell more than 1 basis point to settle at 4.30%. And just for your information, 1 basis point is equal to 0.01%, and bond yields and prices move in opposite directions, which means that as interest rates rise, bond prices fall, and vice versa. In the commodity markets, oil prices rose sharply on Thursday as investors fear that a prolonged war in the Middle East will continue to block traffic through the Strait of Hormuz and inflict long-term damage to the region's energy infrastructure. Comments from President Trump during his Wednesday evening national address warned of further military aggression against Iran in the next 2 to 3 weeks, dampening hopes for an imminent de-escalation in the conflict and driving oil prices much higher. However, oil prices eased off from these heights after reports from the Iranian state news agency said that Iran was working with Oman to draft a protocol to monitor transit through the Strait of Hormuz, where 20% of global oil production passes through. In response, the price of the global benchmark Brent crude gained nearly 8% before settling at $109.03 per barrel, whilst the price of the U.S. benchmark, that is West Texas Intermediate crude, rose more than 11% to close at $111.54 per barrel. In the precious metals market, the price of gold fell on Thursday as the US dollar and oil prices both rose after President Trump said that the US would continue its attacks on Iran for the next 2 to 3 weeks, spurring concerns about inflation and bolstering expectations of higher interest rates going forward. Following these developments, oil prices climbed higher, and this is expected to feed through into broader inflation and further reduce the scope for central banks to cut interest rates. Despite its status as a hedge against inflation, gold usually performs poorly when interest rates are high, and this is because gold does not pay out a regular coupon like a bond. The price of spot gold has fallen by 13% since the war started on the 28th of February and was down by 3.6% on Thursday before eventually closing at $4,587 per ounce. We now change scene to the Kenyan financial markets, and we start by looking at the cost of living in Kenya, as the latest data shows that headline inflation increased marginally to 4.4% in the month of March 2026, up from 4.3% in February, largely driven by higher non-core inflation. Meanwhile, core inflation, which excludes food and energy prices, these remained stable at 2.1%, whilst non-core inflation, which focuses on food and energy prices, this increased to 10.8% and was up from 10.1% in February, and this was mainly on account of higher food and energy prices. In the domestic foreign exchange market, for the second week in a row, the Kenya shilling continued to slide versus the US dollar, and according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.99 compared to a rate of 129.72 the previous week. Meanwhile, the sterling pound was priced at 171.98 and the euro was valued at 149.94. And on the regional front, one Kenya shilling was changing hands for 28.79 Ugandan shillings and 19.96 Tanzanian shillings, and to the Rwandese franc, it was posted at 11.23. The IMF has previously raised concerns about the extreme stability of the Kenyan shilling, but the central bank continues to insist that it operates a floating exchange rate policy. However, the data tells a different story, as the dollar-shilling rate has been stuck at between 129 to 130 shillings over the past 2 years and now appears to be operating like a fixed exchange rate. Given this previous price action and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the Kenyan shilling still remains negative, and this is evidenced by the country's excessive national debt, which now stands at about 70% of the country's gross domestic product and consumes about 65% of total revenue collections. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves declined by $366 million for a grand total of $13.65 billion, which is equivalent to 5.8 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. The recent increase in forex reserves was attributed to the issuance of a dual-tranche Eurobond for $2.25 billion that was partly used to buy back existing Eurobonds that were approaching maturity. Despite this relatively massive position, Kenya's foreign exchange reserves still remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. In the money markets, during the past week, the interbank market remained sufficiently liquid and was also supported by the central bank through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and interest rates in the interbank market. The overnight interbank rate, which is now referred to as the Kenya Shilling Overnight Interbank Average, aka Kesonia, this is the rate that banks use to lend to each other and is now the new reference rate for lending transactions by commercial banks. The overnight interbank rate was stable at 8.74%, which is in line with the current central bank rate at 8.75%. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio that is currently set at 3.25%, this averaged at around 6.2 billion shillings. And just for your information, the cash reserve ratio is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 2nd of April, and the central bank received bids totaling to 17 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 70%. The central bank ended up accepting 16.95 billion shillings, and the results of the auction were as follows. The 91-day rate dipped by 2.6 basis points to settle at 7.40%, whilst the 182-day rate was stable at 7.83%, and the 364-day rate was a shade lower at 8.27%. In the primary bond market, the auction for the monthly bond issuance was held on Wednesday, the 1st of April, and the central bank, which had offered for sale 2 reopened fixed coupon treasury bonds, ended up receiving bids totaling to 74.8 billion shillings against an advertised amount of 40 billion shillings, representing a performance rate of 187%. From the bids received, the Central Bank of Kenya accepted 50.1 billion shillings, and the results of the auction were as follows. For the first bond, which is a 15-year bond with 8.9 years left to maturity, the Central Bank accepted 36.4 billion shillings at a weighted average rate of 12.18%, compared to the bond's coupon rate at 12.75%. And for the second bond, which is a 25-year bond with 17.3 years left to maturity, the central bank accepted 13.7 billion shillings at a weighted average rate of 12.98% compared to the bond's coupon rate at 13.40%. Up next is our topical issue. And this week, we're looking at the issue of Treasury bond interest payments. Kenya's Controller of Budget had earlier in the week flagged delays in the settlement of Treasury bond interest obligations to the tune of 53.5 billion shillings. Based on Exchequer records, the Controller of Budget reported that Treasury bond interest payments that were due in May and June 2025 were settled in July 2025, raising concerns about the government's ability to meet its obligations on time. The National Treasury, however, dismissed the claims that the Treasury bond interest payments had been delayed, insisting that all obligations were settled on time. According to the Treasury, the allegations of delayed interest payments were inaccurate and potentially misleading. Whilst the amounts may have appeared outstanding within the Exchequer reporting framework, the full obligations were duly settled on the due dates in May and June 2025 through the government's overdraft facility that is maintained at the Central Bank of Kenya. The Treasury said that the payment of Treasury bond coupons through the overdraft facility was in line with established cash management and overdraft operating procedures. According to the Treasury, the overdraft facility serves as a standard liquidity buffer, allowing the government to bridge temporary cash flow gaps while ensuring critical payments are not disrupted. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if that is the case, please share this podcast with your family and friends and help to keep them informed of the latest developments in the financial markets. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. And for more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major distribution channels such as Apple Podcasts, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address. That is jamuhuri@gmail.com. Jamuhuri spelled JAMUHURI. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, doubt kills more dreams than failure ever will. A quote by Susie Kassan. Think about it. Thank you, and God bless.